Our next guest is none other than tax attorney badass Jeffrey B. Kahn.
There he is, Mr. Kahn, board certified tax attorney. How you doing, sir?
I'm fine, Joe. How are you?
Doing good. Great to have you here. I tell you, this is something, Jeff, I want to talk about today, which is, I believe, paramount importance for people out there who are conducting business, who own their own businesses or want to own their own businesses. Because when you're structuring your organization, it's not just about taxes, although that's a big consideration. It's also about the type of partners you're going to have and what the interaction is going to be with those partners, what kind of role they're going to play. Are they going to be partners and W-2 people? There's so many things to consider. I think a lot of people just run out and do LLCs all the time.
I agree.
Just run around and grab an LLC. They don't really think about it. So I would love to kind of go down that list with you and say, all right, what are the things that we should be considering between like an S corporation or C corporation and an LLC or a sole proprietorship for that matter, and how do those things, and how should people sort of go through that list and make an educated decision from it?
All right. Well, that whole process you just described, we call that choice of entity.
Okay.
And the biggest mistake is just to run in and say, oh, LLCs, they're new, maybe it's a sexy thing to do, it's the right thing for me, so I'm going to do an LLC, and that could be a big, big mistake. So there's a lot of different factors to look at as to what entity is right for you. And of course, the easy thing to do is you just don't form an entity and you have what's called a sole proprietorship. And that's usually not a good idea to do because, first of all, you don't have limited liability. Any contracts you enter into, any obligations you enter into, if somebody's going to sue the business, they're suing you. It's your individual name that's on the line. Plus, all the transactions, that'd be all the income, all the expenses, gets reported directly on your 1040, which raises the chances that you're going to get audited. So that's another consideration as well. And the IRS always likes, for any business, even an unincorporated business, that you keep a separate set of books and records, that you have a separate account to get the receipt of the money, pay your expenses and stuff. So already I would steer people away from doing a sole proprietorship and instead forming an entity, whether it be an LLC or some kind of a corporation. And that's definitely the way to go.
Even if you're, let's say, an individual person, you can still form a corporation.
That's correct.
Right?
That's
so
correct.
You don't have to have lots of employees or even partners for that matter.
Right, and you don't even need to have a premises. You could be operating out of your house and still go ahead and form one of these entities and have the benefit of limited liability.
Which makes sense.
For one thing, yeah.
So for most businesses, it makes sense. Now I know when I switched from an LLC to an S corporation, we were able to save a little money on taxes, and that was, I think, based around the idea of taking a W-2 wage and then doing distributions versus just sort of the what is it, the K1?
Yes, and taking a distribution.
Yeah.
So and actually both with an LLC that's taxed as an S corp and an S corporation, you can take distributions, and those distributions generally aren't taxable, but any income at the LLC or the S corp level will flow to you individually that you have to report that on your tax return. The difference, though, between the two is that with an LLC, you can't claim wages. In other words, you can't take W-2 wages. It's only distributions. With an S corp, though, you can take some of your monies in the form of W-2 wages with the taxes being withheld, and you can take some of your monies as distributions. And it's that combination that typically produces a lower payroll tax liability, and that's where you can get some nice savings by using the S corp versus utilizing an LLC.
Gotcha. Okay, so that makes a lot of sense then. And then there's, I guess C corps I've heard, or at least my understanding is that those are for like bigger organizations.
Yeah, well, C corporations, basically a corporation is going to be the same under state law, whether you do this S election tax status or you don't. So a C corp is just a regular corporation. You didn't elect S corporation status. With a C corp, you have double tax. What that means is that a C corp that generates income will have to pay a corporate income tax. When it makes distributions, the shareholders that receive those distributions are picking up dividend income, and they're paying a tax on that. So it's double tax. You don't have double tax in flow-through entities like with an S corporation or with an LLC.
That's huge information from a tax perspective for people who are out there looking to form an entity or re-look at the one you've already formed, which is what I did. I did an LLC because I thought that's just what you did. Like in my mind, and I thought I was pretty educated about it, but really wasn't. But I thought I was. Well, you start as a sole proprietor. And then when you finally start, having some assets, then you form an LLC.
Right.
And then you get some employees and things like that, and then you go into, forming a corporation. And that was just what I thought was the case. But there's other factors too, as far as like if you have partners, and what are those partners going to be doing? What are their roles going to be as to which entity you should form, right?
Exactly. So who you're in business with, even the type of business that you conduct. I would have a different answer for somebody who came to me who wanted an entity that was going to hold real estate for rent versus an entity that was rendering services or doing some kind of retail or wholesale operation. So that plays a factor too. It also plays a factor in terms of any kind of priority payments that are going out to investors. You could have an investor who's going to be a silent partner. I'm just going to invest money in the organization, and this other guy's going to take care of all the management. He's going to put in all the sweat, into that. And so there may be a different kind of compensation or, distribution, priority order to make, and that also can drive what kind of entity that you're going to end up selecting.
Yeah, I would like to see everyone just sort of kind of take a look at this. I think that's the takeaway today is really take a look at the organization that you formed, and is it set up in the right fashion? Especially the small business owners out there who maybe just put something together, slap something together. I'll tell you one thing, there's definitely a lot of sole proprietors out there.
Oh, there are.
And that's a dangerous thing. I mean, if you have any assets at all, that's a dangerous thing. I mean, I hope you're well insured, because you have no protection.
Yeah.
I mean, essentially you are it. Because the way California looks at it, Jeff, isn't it? Corporations are looked at like a person, essentially, in the state of California. They're sort of treated that way.
Well, it's a separate entity.
Separate entity, completely
That's right.
separate person. So even if you're a single individual and you have this corporation, you are separate of that corporation.
Exactly, and a good point from that is what if that single shareholder passes away, the corporation still continues.
Right.
Has a life of its own.
It does. And that sort of goes into the whole idea of the business plan, the exit strategy, all those things that people should also be doing.
Right.
A little next level stuff there. But I think, is there a difference, let's say, in the different entities and how tax records have to be, how long they have to be kept or how they have to be executed, or is it pretty much going to be the same with each entity?
It's pretty well much going to be the same because it's all based on the statute of limitations. No matter what type of entity you are or an individual, the IRS has got a specific time period by which if they're going to select a return for audit and make an assessment, they have to do so. Generally, that time frame is 3 years. There are circumstances where it could be 6 years. There are circumstances where that time clock never starts ticking. So it just all depends. Kind of a good rule of thumb would be 7 years, but there are exceptions where you'd still want to keep your records beyond 7 years. The biggest one would be you own a piece of property. You buy that property now. You don't know when you're going to sell it. You may sell it 10, 20 years from now, but when you sell it, in order to substantiate what basis, what the purchase price was, you're going to need to have documents on file to show, hey, I bought this property 20 years ago. Here's a copy of the closing statement showing how much I paid for it. So that clearly is a document you're going to want to keep way beyond 7 years.
Yes, absolutely. We're seeing a lot of people right now are actually kind of coming into the capital gains exemption on selling their homes. Has been a big thing because prices have gone up so much.
Sure.
A lot of these people are getting to the ceiling there. And I've actually seen and talked to several people who are going to sell their home because they've reached the threshold.
Right.
I think it's $250 for a single person, $500 for a couple.
That's correct.
People have gotten to the end of that $250 that I know of, and they said, well, at this point, it's kind of a grand slam, isn't it? I've been here for a couple of years. I'm up to $250, which is my max. for no tax,
Right.
I should probably just go ahead and take that off the table.
Right,
It doesn't get any
right.
better than that.
Right.
So, but it is just a capital gain tax, right, when you go above that? So
That is correct, yes.
Okay, so it's at a lower rate than
Yeah.
income tax for people out there who have huge profits in their properties, which is a lot of people right now. It really
That's
is.
right, that's right.
And it's a good thing to keep in mind of as you're looking at this, a lot of business owners, property owners as well. So I think the big takeaway today, and the thing we really want everyone to do, is to just consider how you've formed your entity. Look at your partnership. Does it make sense? Are you leaving money on the table, on the tax table, which could be possible? Are you leaving liability on the table? These are all things that should be considered, because it's all important to the scope of not just the value of your business, but the security that you're creating for yourself and ultimately your family, right?
Correct.
Thank you for your time, Jeff. Really appreciate it.
All right, thanks.
And thank you for watching Smarter San Diego TV. We'll be back again next week, same time, same channel. We'll see you then.